everyone, I'm Karunya Rao, and in Ideas for Profit, the spotlight is on Avenue Supermarts. The company's reported operating margin in Q1 FY22 was marginally lower than estimates, affected likely by higher share of groceries. As indicated in the pre-quarterly update, revenues grew 34% on low base of the corresponding quarter and reached 90% of the pre-COVID levels. Majority of D-Mart's revenue comes from the grocery segment, which is essential in nature, and it has therefore led to a substantial improvement in the top line. Meanwhile, the stock, if you look at it, has outperformed the benchmark index, delivering a return of 20% in the last 3 months compared to Nifty's return of 10%. Likely normalization of economic activity due to steep reduction in COVID cases, improved pace of vaccination and resumption of store expansion should kick off the robust earnings growth cycle for D-Mart. According to the management commentary, lockdowns and restrictions are gradually easing across multiple cities. Daily cases in the second wave of COVID-19 have reduced significantly, leading to unlocking of the economy by various state governments. With increased pace of vaccination, economic activity is likely to normalize in the near term, leading to resumption of growth for the company. With pickup in sales momentum, D-Mart stated that the inventory levels are gradually moving towards normalcy. D-Mart had highlighted problems of excess inventory in the preceding quarter, which is Q4 FY21. It stated that the construction activities have commenced at its new store sites, which indicates faster resumption of new stores going ahead, leading to strong growth momentum. D-Mart Ready, which is the online shopping arm of the company, has been ramping up quite rapidly. D-Mart is gradually enhancing presence in Mumbai metropolitan region, Pune, Ahmedabad, Bengaluru and Hyderabad. Management has indicated that the online initiative is receiving very encouraging response from customers. With the second wave of COVID-19 and related restrictions and people wary of stepping out of their homes, D-Mart Ready's business has received an increasingly strong impetus. D-Mart's operating margins at 4.3% improved 140 basis points year-on-year on low margin base of Q1 FY21, but they were still lower than expectations. Gross margins declined 110 basis points YOY to 13.1%. We believe higher share of grocery, which is relatively a low margin segment in times of COVID-19 second wave, led to decline in the gross margins. On a sequential basis, operating margins dropped sharply by 400 basis points. With the COVID second wave witnessing a significant surge in infections, the pace of store additions continued to be subdued in Q1. D-Mart added only 4 stores during the quarter, which is about half the number of stores added in the pre-COVID-19 times. In fact, D-Mart, if you remember, added 8 new stores during Q1 of FY20. However, with the resumption of store construction activities, we expect faster additions going forward. With reduction in cases and improved pace of vaccination, we expect the business activities to normalize. Also, new store additions are likely to resume pace in the current fiscal, which would pave way for resumption of strong earnings growth cycle. We expect about 53% earnings CAGR over FY21 to 23 period. D-Mart, if you remember, follows everyday low cost, everyday low price strategy, which aims at procuring goods at competitive price using operational and distribution efficiency and consistently delivering value for money to customers. It follows a cluster-based strategy for expansion, which ensures operational efficiency. With pickup in the organized retail segment and with current store network of about 240 stores, D-Mart definitely has extremely strong potential for growth. The retailer has a strong balance sheet position with cash and cash equivalents worth 2,500 crores, which will ensure that the company is well positioned to capitalize on the growth opportunities going forward. D-Mart is among the fastest growing retailers with a track record of a robust 40% earnings over the last 8 to 10 years. This is pre-pandemic levels, of course, and it's the only listed play in the grocery retail segment. At current price, the stock is trading at 86x of its FY23 projected earnings and EV/EBITDA of 56 times its FY23 projections. Higher valuations would sustain given the resumption of strong earnings growth. Therefore, we advise investors to add the stock to their portfolio.